Let's bring in our headline guest now, Adam Parker, to weigh in on the markets. He's the founder of Trivariate Research. AP, welcome back.
Good to see you. How are you?
I'm well, thank you. You know, I looked at your note today to our producer, and you say, generally, I remain bullish for the reasons I have talked about for the last 18 months. And I thought to myself, why would he say generally I remain bullish? Because you've been unwaveringly bullish. And are you saying now I'm basically bullish?
No,
I'm mostly bullish?
No, there's no nuance. I'm bullish. I think of the people I heard, I guess for me and my clients, it's not useful to try to make 2 or 3 week cautious calls or 1 month cautious calls. I try to sort of stick to the big picture. I always think of this analogy, Scott, you might like. Imagine you're walking your dog around Central Park. Okay, your dog's going to go sniff at stuff and climb at trees and chase butterflies. But when you ask me where the market's going, you know, I mean, I think about it. Am I on Central Park South? Am I on the east side? Am I on the north? Or am I on the west? Like, where am I holistically? Not where am I running around? Where's my dog chasing? Holistically, I'm bullish. You know, earnings are going to be fine. I think the conversation should be about what impedes earning progress for next year. That's the key. And I think earnings are going to be fine. I think the Fed's going to remain accommodative. I do think there'll be a fiscal, whether it's $1 trillion or $2 trillion, I don't know, but it's all probably bullish. And so I don't really see why I should be super cautious. But as you know, and we've talked about many times, you always sound dumber when you're bullish.
No, but I mean, the question is how bullish? And that goes right back to the is this as good as it gets environment when you have, you know, a disappointment.
I think the market can go up, you know, high single digits, low double digits over the next 12 months. You know, I have a 1.7% dividend, a couple percent net buyback. I think earnings grow mid-single digits to higher, probably trough in Q1, Q2, and then grow again. So, you know, that's a pretty good cocktail versus almost anything else out there I see investment-wise. So I don't see why I can't have high singles, low double-digit returns over a 12-month view. It's pretty good.
What do you think about growth, though? I mean, if I say, okay, growth is not going to be what we thought it was going to be, and the Fed is going to start taking a little bit of the punch out of the punch bowl, doesn't that have an impact? Oh, by the way, taxes may be going up, and we're not going to get as much of a stimulus package as maybe we once thought we would. Doesn't that all like A plus B plus C plus D equals maybe E isn't exactly what I thought it was going to be?
Yeah, let's back up and say earnings are up 20%. Like analyst expectations are now 20% higher for earnings than they were on January 1st, and the market's up 20%. So maybe it all makes sense. I mean, if you're saying that we're going to have bad growth and the Fed's going to get, you know, more hawkish, then yeah, that's not a good cocktail. I wouldn't dispute that.
I mean,
I don't think they will. I think that they are the smart ones. I don't believe that. I kind of loathe it when people make fun of the Fed and they say the Fed are dumb and they're late and all that stuff. I think the Fed wants to create inflation. They know how to control that through conventional activity, right? And so they want to run hot. They're going to wait and see how transitory it is. And I don't think they're going to remove the accommodation anytime soon. I worked at a big firm for a long time, and they were calling for backup rates every single quarter for, I don't know, several years. And the Fed acted years and years after they thought.
Man, don't throw your former peeps under the bus, all right? Don't do that.
I've always been an equity guy. I'm just saying lots of smart people try to make the back-end rates call and aren't right. So we'll see what happens there, but I don't think the Fed's going to remove the accommodation anytime soon. So, but I hear you. Like, if you're painting the picture of Adam, growth is going to disappoint at the exact moment the Fed removes the accommodation. Yeah, that's not going to be great.
But I mean, I
just don't think that's going to happen.
Do you think that the recent events related to the economy, whether it's consumer spending or sentiment or the weaker than expected, much weaker jobs report, do you think that has now changed the timeline for the taper?
You know, it's tough to know on the taper. Like, I do think, and you probably remember years ago when I wrote this first, you know, we wrote that whole notion of bad is good and good is good. And I kind of feel like that's the regime again here, right? Bad news economically, a little bit of light retail sales, a little bit light jobs, right? Maybe that's good because then the Fed remains accommodative longer. And if we end up getting good economic news in a couple of months, that'll be good because people say, wow, things are good. So I think we're in that Goldilocks a little bit, Scott, where I think the Fed remains generally accommodative. I think earnings are going to be fine. I don't see those corporate impediments, tons of inventory, tons of CapEx, lots of dumb hiring, big fancy new corporate headquarters. I don't see any of those signs of management hubris. I don't have any debt due at the company. So I think earnings can grow pretty well. And so, sure, I'm going to peak mathematically. I peaked in Q2. It's going to trough sometime Q1, and that's going to accelerate again. So if people want to pay a 3-month wiggle on a down 5, I don't know. Of course, the market can go down 5%.